Have you ever been in a perfectly clean trend? Everything looks great, and then suddenly the market pulls back and messes with your entire plan? Now you're stuck with a big question every trader faces in this moment. Is the trend still strong, or is this the exact moment the market is about to reverse? Most traders panic here, but here's the interesting part. There's a pattern hidden inside the RSI that often tells you what's going to happen next before price makes it obvious. A pattern that reveals whether the trend still has real momentum or if it's losing strength behind the scenes. It's called the RSI Range Shift. By the end of this video, you'll be able to look at a chart, check the RSI, and quickly tell if the trend is strong and likely to continue. So stay with me until the end. Understanding the real purpose of RSI. Before we dive deep, I want you to completely reset the way you think about RSI. Most traders treat RSI like a simple overbought and oversold detector. 70 means sell, 30 means buy. But that's honestly one of the biggest reasons they keep losing in trending markets. Here's the real purpose of RSI. It measures strength, not highs and lows. Think of RSI like a heartbeat monitor for price movement. When the trend is healthy, the heartbeat stays strong. When the trend gets weak, the heartbeat slows down. And if you learn to read that heartbeat correctly, you can understand the trend long before price makes it obvious. This idea, understanding the strength of the trend, not just the extremes, is the foundation of the range shift pattern. So when you open your chart, don't stare at 70 and 30. Forget that for now. Instead, paying attention to whether RSI is showing a strong momentum or losing energy. That's where the real story is. What a range shift actually is. Now that we understand that RSI measures the strength of a trend, we can finally talk about one of the most important behaviors it shows, the range shift. A range shift happens when the natural movement zone of RSI changes. Instead of oscillating around the same levels, the RSI begins to operate in a completely new range. In a normal or neutral market, RSI tends to move back and forth between the middle levels, often hovering around the 50 area. Price pushes up, RSI rises. Price pulls back, RSI falls. Nothing special is happening here. The market is simply moving without a strong direction pressure. During the early ages of a strong bullish trend, the RSI stops dropping to the levels it once reached. Price still pulls back, but the RSI refuses to fall as deeply. Instead, it finds support higher on the scale and its peaks begin rising. In a strong bearish trend, the exact opposite happens. RSI stops climbing to its previous highs. Even when price bounces, the RSI can't rise as much as before, forming lower highs and holding lower ground. This shift, when RSI begins to operating in a new higher zone for uptrends or a new lower zone for downtrends, is what we call a range shift. And it's important because it signals a real change in momentum. One side of the market has taken control and the internal structure of the trend has clearly shifted. In other words, the market is no longer just moving, it's trending. And when RSI shifts its range, it often signals the trend has enough strength to continue. RSI range shift in an uptrend. When a true bullish trend begins, the RSI shifts into a very special and reliable behavior. Instead of oscillating inside its old neutral zone, it starts operating in a higher elevated range. Here's what that looks like. During pullback, price still dips, that's normal, but the RSI doesn't fall to its previous lows anymore. Instead of dropping toward the 30 and 40 zones, it now finds support closer to the 40 and 50 area. That higher floor is the first early sign that buyers are gaining real strength. At the same time, the highs on the RSI begin pushing further upward, often rising into the 60 to 80 zone. This shows that bullish momentum is not only present, but expanding. So, in a healthy uptrend, the RSI creates a new home base. It stops living between 30 and 70 and starts living between 40 and 80. That right operating zone is the range shift. And here's the key idea. When the RSI constantly holds above 40, even during deeper pullbacks, it confirms that buyers are still in control. The chart may look messy, candles may look choppy, but underneath all of that, the strength of the trend hasn't changed. This is why the range shift is such a powerful continuation signal. It often tells you that trend isn't weakening, it's preparing for another move higher. RSI range shift in a downtrend. When the market enters a strong bearish phase, the behavior of RSI changes in a very noticeable way. Instead of moving freely across the middle of the indicator, it begins spending most of its time in the lower half of the scale. One of the first early signs of a downtrend appears during small pullbacks. Price may bounce a little, but RSI doesn't rise like it used to. Instead of reaching the 70 area, it now stops around 50 to 60 and forms lower highs. At the same time, downward pushes in price begin to drive the RSI much deeper. The indicator repeatedly drops into the 20 to 40 zone, showing that selling pressure is dominating the market. Over time, this creates a clear shift in the RSI's natural operating range. Instead of fluctuating around the middle levels, the indicator now spends most of its time between 20 and 60. This downward relocation is what defines a bearish range shift. The meaning behind this behavior is simple. Buyers no longer have enough strength to push momentum upward. Even during price bounces, the market can't generate real bullish power, which confirms that sellers still control the trend. Because of this, a bearish range shift often signals that the downtrend still has momentum and may continue pushing lower. So, in summary, these ranges help us understand who is controlling the market. In a bullish market, RSI usually stays between 40 and 80. The key idea is that pullbacks often stop around the 40 level. In a bearish market, RSI typically moves between 20 and 60. Bounces usually fail near the 60 level. So the two key levels to watch are 40 and 60. These levels often tell us whether buyers or sellers are in control. Now let's look at real chart examples to see how this works in practice. How to use RSI range shift in real trading. RSI range shifts often appear before major price moves, giving traders an early signal that momentum is changing. Let's look at a real chart example. At first, the market is moving in a neutral range. RSI fluctuates around the middle level, but then we start to see a change in RSI behavior. During a pullback, RSI drops to around 40 and then turns upward again. Later, RSI pulls back again but still holds above the 40 level. Because RSI stays above 40, it shows that buyers are still in control. This becomes an early momentum signal. As you can see, after this signal, the market begins a strong upward move. Now look at this bearish example. Here RSI is also moving in a neutral zone at first, but eventually the behavior of RSI changes. During each bounce, RSI only rises to around 60 before turning downward again. Even when RSI moves up, it cannot break above the 60 level. This tells us that sellers are in control and that bearish momentum is building. As you can see, price drops significantly after this signal. Learning to recognize these early shifts in RSI can help you enter trades earlier and with more confidence. Alright, that's it for today's lesson. Now you know exactly how this pattern works. Whenever you see RSI holding its special range, you'll know the trend is still alive, and that gives you way more confidence in your continuation trades. If you like this lesson and want more smart RSI techniques that actually work with real price action, check out the next videos in this series. I've linked the playlist in the description. Thanks for watching, and I'll see you in the next video.